Hi, and welcome to Random Rogers Big Picture. It's been a while since we've done a video, but a reader reminded me about talking about performance for 2009. Long story short, this sort of discussion based on our perception of what is compliance and what isn't in terms of putting stuff in writing versus speech making is that to talk at all about performance needs to be done via video, so that's what we're going to try and do here. Okay, so the S&P 500 for 2009, regardless of anything else, was up a lot, up 23.5%, plus the dividend, which probably about 200 basis points. Anyone so inclined can, do that, but it's in the neighborhood of 200 basis points. That is up a lot. If the average really is 9 or 10%, 25% is up a lot. And so in thinking about how you add value, and I alluded to this recently in a blog post, if everything is going up somewhat indiscriminately, then it's tougher to add value. Sector decisions matter a little less. Country decisions perhaps matter a little bit less. Stock picking matters a little bit less. In the Barron's article, it said this was not a stock picker's market. That's some article in the current issue of Barron's. And every year someone says, oh, a stock picker's market, and Barron's says, no, it turns out 2009 wasn't. Side note, I don't think it's ever a stock picker's market, but that's just me. All right, so in that sort of environment, it is tougher to add value, and additionally, if you do a lot of fundamental analysis, or try to, let's put it that way, if you try to, then you may be slower to get back in. That might be a way to describe what we did. I'll leave that up to you. For the year, and I'm going to be a little bit vague so as not to frustrate anyone unnecessarily. We were up in the high teens versus about 25% for the market, so we captured most of the ride. If you compare it to what I talk about, smoothing out the ride based on how little we were down, then based on what we were up, the ride is smoother. With the close of 2009, we are mid-single digits. Now I'm just talking about the equity portion of the portfolio only for proper context. We're down mid-single digits from our high water mark in October 2007 versus the S&P 500 is down, I think, 28.75% from its high water mark in October 2007. So I feel pretty good about having smoothed out the ride. To borrow someone else's terminology, 75-50 from John Serapere, which is getting 75% of the upside during the cycle, a full cycle, and 50% of the downside. Maybe we did a hair better on this go-around. We may or may not be that lucky again on the next go-around. Don't know, but in coming years, through the rest of the bull cycle, if you think a new bull cycle has started, and I'm not quite there yet, but if you think that's the case, then a large portion of the gain was observed this year off of the March low. The move from 666 up to, I think we closed at 1115, that's going to be a huge portion of the entire bull market move, assuming it's cyclical. If it turns out to be secular, and we do the equivalent of going from 300 up to 1500 like we did in the 90s, then I guess it won't matter so much. I can't imagine that's in store. But let's talk a little bit about some of the things that we did. We were going into the start of the year very defensive. Cash position in the mid-20s, maybe even a little bit more. We had a small position in SDS, which is a double short ETF that grew into, not a large position, but into a much bigger position than it started out as. We were defensive, and then we started adding positions. Of course, we bought a whole bunch of stock on March 9th. I'm joking about that, of course. You see everyone on TV who likes to say that, but we added stocks. We added, a name every so often. We added Caterpillar at one point along the way. We added the discretionary sector spider along the way. Another point we added Suncor. At another point we added emerging markets infrastructure. Those last two came a little bit later on. And the idea there was trying to add something that would be a little more volatile, adding a little more volatility to the portfolio, with the idea being that you kind of get more bang for the buck. It's a way to keep some powder dry, but perhaps catch more of the rally. I mean, that's the idea behind the strategy, is capturing more of the rally. It either works or it doesn't. You know, as the year went on and the market kept going higher, we kept getting longer and longer as the cash position shrunk relative to the equity holdings, or put another way, the equity holdings grew in larger proportion, so we look more and more like the market. And you know, in most of the time, we now look a lot like the market, despite still having a fair bit of cash. But there are certain instances where we absolutely will lag the market. In a day where financials lead, or junk stocks, for lack of a better term, do well, we're going to lag that type of move. We're heavy into foreign, as we've always been, and emerging. And so if there is some sort of risk aversion, we will lag in a risk aversion environment where the dollar goes up. But in terms of thinking longer term, I think that's where we want to be. So just to recap, we definitely lagged. From here going forward, if the market keeps going up, we will lag less. High teens versus mid-20s, you can label that with any adjective you want. I feel pretty good about that in terms of delivering, in the context of the entire stock market cycle, what I hoped to deliver for clients, and I hope that we can repeat that again for the next cycle. Obviously, you never know what that will bring, but I do want to repeat again, equity portion only, based on a model portfolio that is unambiguously representative, but it is not a client account. It's usually, you know, very, very close. But for anyone who maybe is a little better than that or a little worse, okay. On some other period of time, it may flip-flop. If you're better than that now, you may be worse than that on the next go-around. That doesn't matter. What matters is that you're not down anywhere near the 28.75% that the S&P 500 is down in the last 2 years and 3 months. All right, that's it. I'm going to need to walk back toward the camera to turn it off. My camera operator has left, so you get a little view of what we've got here with some snow in the background.